All right. Good morning, good afternoon, traders. Today is Wednesday, September 10th, 2025, and this is You've Got Options for Income Navigator. Today, we're going to talk about short SPY put campaign, and I'm going to talk about the second version of the campaign that I have been running for about 4 years now. To give you a little bit more context about where this has started, or version one, and then we'll talk about how it evolved and what I'm doing right now. What you are seeing on your screen right now, this is a spreadsheet where I keep track of all of the trades that are part of the short SPY put campaign. This was version one that started back in 2021. And this trade was very simple. I would put on a short put trade 3 times a week: Mondays, Wednesdays, Fridays. I chose those days randomly. It worked for me. It could be Mondays, Tuesdays, Thursdays. It could be Wednesdays, Thursdays, Fridays, whatever it is. My goal was to put on the trade 3 times a week. I was looking to sell an out of the money put in SPY, and I was looking to collect about $1.20 credit, or whatever was closest to it. Sometimes it worked out to be $1.20. Sometimes it worked out to be $1.24. Sometimes it was $1.19. As you can see, these credits varied, and at times, once I started to accumulate a number of these short puts, sometimes the market wouldn't move a whole lot and volatility wouldn't change from a Monday to a Wednesday or from a Wednesday to a Friday. So instead of selling another put on the same exact strike, if there was nothing available around a strike that I already had, I would have to go to maybe a different expiration, or I would have to go up or down one strike. So as you can see, sometimes my credits were higher than $1.20, and it would remain so until something around $1.20 became available again. My DTE, I was looking for around, so I started off with about 50 days, and then as I was looking around for other strikes, sometimes I would move to 60 days. And there were times where I would have to go as far as 78 days, 74 days. It doesn't really matter. My window for this trade was I would start to put on these short puts at around maybe 80 days until expiration. And I would stop adding to the same expiration cycle at about 45 days. Right. The closer we get in time until expiration, the closer to at the money I would have to sell these naked puts. And instead of going for faster decay with expirations that are getting closer to expiration in time, I would choose to go a little bit farther out in time, right? Roll to the next expiration cycle, and I would exchange the rate of decay for the distance out of the money, meaning if I moved on to a expiration cycle with 80 days from 45, my strikes would be a lot farther out of the money, which gave me more safety. But in exchange for that, I would give up the rate of decay of these naked puts that I was selling. And I was okay with that too. I was only looking to stick with monthly expirations, but we didn't have to do that because weekly expirations work fine too. And if you look at SPY and how many expiration cycles there are available, there are plenty, right? So if you don't only want to stick to one expiration cycle, you can sprinkle your trades, any way that works best for you, especially if you don't want to move up or down in strikes. If you're specifically looking for a certain dollar amount as your credit, and you don't want to move closer or farther out of the money and change the dollar amount, you can change the expiration cycle. And sometimes you will find expiration cycles for SPY where they have, instead of $5 strikes, right, they have a $1 strikes. And those are probably best, right? Because, for example, right now I'm selling strikes at 605, and then maybe on Friday I come in and the market hasn't really moved a whole lot. Instead of going to either 600 or 610, I can look at 604, 603, 602. So I really like to sell options in those expiration cycles that have $1 strikes available for SPY. So this was the trade. 80 to 45 DTE was my entry window. I was looking to sell a put for about $1.20 credit. My target, my profit target was 80% capture of 80% capture of my credit that I collected, and my exit was either 3x loss on the trade, or I would be willing to take the assignment, take the shares, and then potentially sell covered calls against long stock position to get myself out of the long share position. As you can see, this was from 2021, and this campaign ended in around May of 2025. In this time frame, right, this is not some back testing. There's a lot of that going on YouTube. The gurus come out with back tests, with whatever data they're able to get their hands on, right? These are trades that would put on and they were taken off. Not all were winners. A lot of them were winners. There were definitely some losers. We'll talk about that as well. But you can see total number of trades was 503 trades. They're all closed out. In these 503 trades, 478 were winners. 25 of these trades were losers. Total running P&L, well, this isn't currently running anymore, but total P&L was just shy of $40,000, and all of these positions were one lots. Win rate was 95%. Average credit that I collected was at $1.34. So an average winner was just about $1.05, so $1.05. Average days until expiration was about 64, 65 days, right? So sometimes my DTE was 49, sometimes my DTE was 78, but average days until expiration on entry was around 65 days, and I held the trade for about 34 days on average, right? So about 50% of the DTE. So on average, I was able to get out of the trade at about 50% of the time until expiration, and I was able to capture, we can average, and this isn't going to be, I'm going to have to figure this out. Like if I back out any negative numbers to see what the average winning capture was, but if I had to guess, I would say it was somewhere around 70% or so. Right. So an average winner was $1.05. An average loser was $4.20. And if we look at 420, right, if we divide 420 by $1.35, right, we get about 3.11. So an average loser was about 3x the credit, which is what my goal was, right? My stop loss was 3x credit, and my average winner, which is 105, divided by $1.34. So an average winner was about 0.78, or 78% of credit that I collected. Right. So the numbers kind of worked out as far as I was on target with my profit target. I was on target with my stops. And we can talk about stops. This trade was going on from 2021, so end of 2021, until May of 2025. So there were definitely up markets, down markets, as in 2022. There were a couple of crashes, if you will. August 2024, we had a pretty big drawdown earlier this year, right? Through, we can go back. This was, and you can see there was a stretch of losses, right? Where I was just not willing to take, um, I was not willing to take assignment. So I would stop out. And then if, right, I stop out of half of the positions, and then the other half, I would be willing to take shares and potentially wheel the shares. Um, you can see that in March of this year, right, there were losses because the market didn't really quote unquote crash until about April, but earlier in the year, right, this is end of February and into March, the market was just steady going down, right? It was pretty controlled, but the move was to the downside. And I think that at that point in March, the market was down about 10% off the highs, right? So, or maybe a little bit more, right? So there were definitely losses, right? But they were not too much outside of what was expected. As you can see, actually these losses, and I would put stops on these trades. So they were closed out at 3x credits. So that was in line. Yes, they do suck because, nobody likes to take losses. But if you plan for it, you have to honor your stops. And then when the market really did put the second leg in to the downside, right, there were more losses. And then these trades expired. So there were some trades that would put on in February. They did not get stopped out. And then as the market rebounded by early May, a bunch of trades that I was willing to take assignment, right? These trades that would put on in February and in March, they were at a drawdown, right? But I had the option to either take a stop or take assignment, and I committed to take an assignment on a number of trades: 1, 2, 3, 4, 5, 6, 7, about 8 tranches, right? And the market obviously made a V-shape recovery, and these trades were closed out. You also, one thing you definitely, regardless of which version you're going to do, you always want to consider notional value of the contracts that you're trading, right? Because you may think, oh, I'm just going to put on a bunch of these trades, maybe 10, maybe 12 tranches, and worst comes to worst, I'm not going to stop out. I'm going to take assignment. But if you really think about it, right, and this was when SPY was trading, at these strikes were in the 400s, 510. Right now, I'm selling puts that are in around from 600 to 620. So the notional value of the contracts that I'm doing today is a little bit higher. But regardless, you have to keep in mind that if you were to take an assignment, for example, on a 510 put, that's a $51,000 investment, right? And then if you have a bunch of these, for example, if I was to commit to take an assignment on all these shares, this is 8 tranches. If I chose not to stop out, but to take assignment, this is a notional value of about 418,000. Right, so you need to have that set aside, or to be able to take the shares. Right, so if you're doing this in the $50,000 account without realizing how much notional value you're carrying with all of these short puts, right, you can't take assignment. $418,000 worth of SPY shares in a $50,000 account. So you do have to be aware that if you are going to take assignment, keep track of how much notional value you're carrying. And, if you go beyond to where you can take assignment, you have no choice, but you have to stop out. So keep that in mind, and, don't only focus on, how much profits you're going to make if everything works out. Always think about, what's the worst case scenario if I'm put in a position where I have to take assignment. Do I have the liquidity to do it? If not, maybe you need to move some things around or whatever you need to do to prepare for it. But you have to be ready for it. Just keeping an eye on the chat here, and I see that there are some questions. So Rick T says, why is there a gap between 20 2 and 25. This list is just, it's 500 rows deep. So in order to not have to scroll all the way up and down, I bunched a bunch of these together. So if I unbunch them, you can see that there's a lot of rows here. I just didn't want to scroll way up and way down. We can look at losses that were from 2022. All right, there were also, so 2022 was a bear market, and in 2022, maybe I can also go and isolate each year just to kind of run the same numbers, right? This is a total, but then I could also maybe break this down a little bit more into, what were the numbers, same numbers, how many trades were in 2021, 22, 23, 4, and 5. And then maybe this will give us a little bit of a better idea. But in 2022, there were definitely losses. There were losses earlier in the year. Did not want to get long shares because we really weren't, too far off of the recent highs in order for me to consider taking the stock. So I decided to stop out, and the losses were within, the goal was to stop out at around 300%. Some exceeded that. Some didn't quite reach 300%, but all were pretty much in line with what my plan was. There were 1, 2, 3, 4, 5, 6, 7, 8 losses, and they were all on or about January 24th. Right. So, and then, right, this was not fun. So, like, if you're going to trade something where you're taking 8 losses in a row and then you're going to quit, well, no one's going to tell you what to do, but keep in mind that, in a strategy like this, you may have a bunch of losses to come together and then you go on a run. I mean, if we look at, I think it took like 3 years for the next loss to show up. Maybe not 3 years, definitely 2 years, right? So the last was in 2022, and the next loss didn't show up until August of 2024. Right. So if you stopped out or you got discouraged to do this campaign, and I'm not making the case, I'm not soliciting anybody to do anything, but if you stopped trading here after these losses, you definitely missed out on quite a bit. And we can potentially look at, right? So if we look at between these losses, it was a total of 32.15, right? 32.15. How long did it take? How long did it take for these losses to be recovered? Right. So this is about May. So from about February to May. So it took 3 months to recover these losses. It sucks, right? When you have to spend 3 months just to recover your losses, but then you didn't have any losses until 2024. Right. So that's as an alternative, I could have also, instead of taking the losses here, I could have got assigned shares and then potentially wheel my way out of that. Right. So if you have the capital to do it, and if I was to take assignment, right, this would be about $300,000 worth of SPY shares that would need to be taken, and then covered calls would need to be sold until we potentially get out of this position. So this was 2022, and then we can go forward and get to about 2024. Right, these were also, as you can see, if anybody remembers, in 2024, right, the market really rolled over on 8.5, but the market was already getting weak on a Thursday and a Friday before that Monday, right? So I had 1, 2, 3, 4, 5, 6, 7, 8 positions were stopped out on the 2nd, which I believe was the Friday. And these were stop losses that were put in place together with my entry order. I have shared before, and I'm going to do it again, um, how to create an order ticket where with one order ticket, you send an order to enter and potentially exit at either your profit target or your stop loss, right? There's an one cancels other OCO order that goes out together with your entry. And once your entry is triggered, once you get into your position, you have an OCO order out there to either get out at a profit target or get out at a stop loss. And the reason why, I often say that I don't like to set GTC stops on anything, and I don't. But with SPY being one of the most liquid underlyings out there, and if you look at most of their options have, 1 or 2 penny wide bid ask spreads. Even if my stop is triggered and it becomes a market order, right? You will rarely see a big gap in the bid ask spread for options on SPY. So stop orders work just fine. I also monitor and I know when I'm getting close to within that 300% mark. And if you don't like or if you don't want to use a GTC stop, you don't have to. You just have to know that if you're within, right, if I'm at 280%, I can sit there and wait and monitor, when I get to 300, or I can just get out. It's too close. Maybe you get lucky, maybe you don't. And sometimes you get lucky, you're down 280%, you don't get out, and then the underlying goes the other way and you bailed out. And the other time when you're within, that 300 mark, let's say you're at minus 280%, your stop is at minus 300, you don't get out at 280, and then the following morning, you have a big gap down, and now you're down 500%. Right? So if you don't want to put yourself in that position, I don't know if there's a right or a wrong way to do it. I just think that discretion needs to be applied. If your target to close for a stop at minus 300% and you're already at 280, 285, again, if you want to avoid potentially going beyond your stop loss of 300, closing out at 280 probably makes sense. This way you don't have to wake up to a nasty surprise, right? But in any case, there were 8 trades that were already exited on a Friday. And then on a Monday, by the time the market opened, I had one more position that was closed. I don't think that I have committed to owning any SPY shares. I definitely did not get assigned on any of these SPY shares. So I did pause this campaign for a couple of weeks. I stopped out on 8.5. I had a entry on 8.7, 8.9, and then 8.12, 8.14, 8.16. Right, so we just kept on rolling. The pause that I took was earlier in this year, and then I adjusted to setting slightly different profit target and a stop loss, and we'll talk about that in just a little bit. Right, so this was 2024. We could go back again, look at all these stops. These stops were about $3,800, very similar to what we saw in 2022. Right, so in 2024 we were down about $3,800, and in 2022 we're down $3,200. So yeah, it'll when losses show up, right? Unless you're willing to take the shares and wheel, if you're going to use stops, they can take a decent chunk of your profits, but then you keep on rolling. And if we could go back and look at how long did it take for these losses to recover? About 3 months. Very similar to 2022. Right, so it sucks. I kind of, now we're starting to pick up a pattern here, right? So you get a bunch of losses in a row that take about 3 months to recover from. Right, so I don't know if, if there's something that we can, or if there's one thing that we can implement to prevent that or to cut the recovery in half. I'm not sure. We need to think about that a little bit more. But going forward to 2025, right? So we had some losses in March. So it's about $2,200 in losses. Then the market, it didn't really go up, but it just stopped going down, right? We were just kind of consolidating, waiting for the tariffs to be announced, right? So, and as the market stopped going down, you can see that there were some positions that were closed for a profit. And then when the market finally started to move to the downside again, right, there were some more losses. And this was in April of 2025. So three more losses here. That's $1,300. And then another 2,200. So it's about a $3,500 in losses in early 2025. Right. And then we had $665 and then about $1,700 or $1,800 were recovered. And then I said, all right, what's happening here? And I'm going to spend a couple of more minutes on this older version, and then we'll move on to what I'm doing now. Right. So then I started to say, all right, what's happening here? So when the market is steady and when the market is in an uptrend, right, you can see that we can go for 2 years with these, winners, right? $100, $100, $130, $111, $100, 102, 108, 95, right? So these are nice, and they come off. If the market is just steady or slowly grinding to the upside, you get these trades to close pretty often. There are times when the market is not really moving a whole lot, right? So we're not seeing a whole lot of decay, or maybe volatility is pretty stubborn, or if the volatility is slowly rising, so the premium has become a little bit more sticky. We are adding positions every Monday, every Wednesday, every Friday. Before you know it, 4, 5, 6 weeks go by, right? We have added, 10, 12, 15 new positions. And now, I think at most in this campaign, I had something close to 25 tranches that were open. Was I willing and going to take assignment on all 25 tranches? No. Right? You always have to know how much are you willing to invest into SPY shares, right? How much assignment are you going to take and how much you need to stop out. So for example, if you say, you know what, I would be willing to own $500,000 worth of SPY shares, right? So you say, all right, between all of the tranches that I may have open right now, I'm going to take assignment on the first maybe 8 or last 8 or whatever works best. You can look at the chart and figure out what price levels work best for you. And you say, all right, but I can possibly take $500,000 worth of SPY shares and look to sell covered calls to potentially get out of that position, which means if you're holding, $1.3 million worth of notional value, that means that $800,000 of that notional value you will need to get stopped out if the market should go against you, right? So you have to understand how much you're willing to take, how much you currently have, and you have to start picking and choosing what goes for assignment and what is going to get stopped out, right? So, and if you're going to enter manual stop losses, you kind of need to decide which levels or which strikes are going to get stopped out and which strikes are going to get assigned. Right. So I'm not here to tell you what to do. I'm not telling you what's right and what's wrong. I'm just telling you what is the process that you would need to go through if you choose to do something similar to this. And hopefully this makes sense. Right. So then looking at the stats, I said, all right, I'm on average, I put on the trade that has 65 days until expiration. I have to wait 33 days, right? So about half the time, in order to capture 80% of all of this credit, which kind of made me think that, putting on the trade, and granted, if you sell, and you can go and look, maybe not right now, but you can go look when you're free. You can look at where is a SPY put that is currently trading for around $1.30, somewhere 65 or 70 days until expiration. Most of the time, that's going to be about a delta 5 put, 5 maybe 7, right? So between 5 and 7, right? So, and I thought to myself that selling a put that gives me so much distance, right? It gives me a lot of distance. It's very far out of the money, which gives me a lot of quote unquote safety. But is it really giving me a lot of safety? Or does it trap me in the trade for much longer? Because, even at 65 DTE, a 5 delta put, right? It only has so much premium, and how much of that premium is really going to come out in the first, 2 or 3 weeks? I have to wait 30 days to get 80% of this premium, right? So I thought that, wouldn't I be better off, right? Maybe I stay within the same days until expiration time frame, but if I move my naked puts closer to at the money, collect a higher credit, right? We know that options that are closer to at the money, they have a higher theta component. They lose value faster. They also have a little bit more risk because they're closer to at the money, but they decay faster, right? And most of the time, market is not crashing. So sometimes, the market may go down a little bit and these puts may get pressured, but most of the time they're not. So I said, I'm going to trade a little bit closer to at the money. I'm going to go for a little bit more aggressive exit. And I'm going to need to change my stop loss as well. So what I decided to do, instead of going out and looking to sell a put for $1.20 or $1.30, I started to sell puts that are a little bit closer, and I'm just looking for a put that's trading for around $5. Sometimes a little bit more, sometimes a little bit less, but I don't really like to go for less. So if I can't get anything for $5 because I already have a bunch of strikes around the strike, whatever is currently trading for 5, then I may go to 550, maybe 580. Sometimes it would even go as high as $7.22. Right? So instead of going farther out of the money, right, because those feel safer, in my opinion, they're not safer. What tends to happen, and I'm hoping I'm not going to lose most of you guys here, but think about this. If I'm selling a put that decays very slowly, right, which means that I'm not getting to my profit target for a while, but in the meantime, I keep adding trades every Monday, Wednesday, Friday, Monday, Wednesday, Friday. What happens is, if the market is kind of, neutral, maybe it's grinding lower, right? I'm not exiting, but I continue to add new positions. What happens is I build up an inventory, right, of all these puts that are not really decaying fast enough. So I'm just expanding, or I'm increasing my risk. I'm not getting any of these trades to come off, right? And what happens is, if the market rolls over, kind of the way it did in early 2025, right? Those puts that were supposedly safe, right? I'm still holding these puts. And now if the market rolls over and pushes lower, now I have to either stop out or consider taking those shares. So I don't want to deal with puts that decay so slow. I would rather trade a little bit closer to at the money, right? Get a little bit more rapid decay and hopefully get to my profit targets a little bit faster and turn the inventory over a little bit more. And the answer whether this was a right or a wrong move, I'm only going to be able to tell you at some point in the future. But for right now, these are the numbers that we're looking at, right? So this started in May of 2025, and we're still going Monday, Wednesday, Friday. Sometimes we have a holiday on a Monday or on a Friday, if that's the case, or sometimes I get tied up and I don't get to enter on a Friday, then I'll enter on a Monday and a Tuesday and a Wednesday the following week. But I'll try to, on average, enter around 3 times. And you can see that from May until now, right, we had about, what is it, like 4 months, right? 4 months times 4 weeks, that's 16 weeks. So we had 46 trades in 16 weeks, right? So it's 2.875, very close to. I try to average about 3 trades a week, right? So far I've entered 46 trades. The wins, this number is wrong. Hang on 1 second. The wins, we are going to, it's 38. So of the 46 trades, 38 were taken off for wins, right? So we had 38 closed trades. There have been no losses so far. Average credit, $5.34. Average days until expiration, about 71. I am in the trade for 17 days. Right? And if we look at what we were doing before, average DTE was about 65 and average days in the trade was 33. So these are entered with a little bit more time on average, and it's a much smaller sample, so this number is definitely going to change over time, right? But you can see my days in the trade. And, granted, we have been in a pretty strong uptrending market since May. So just because, right now DIT is 17 doesn't mean that it cannot expand to 20 or 25 at some point in the future, right? These are just the numbers that we have to work with right now. So my average exit is much quicker. Average winner is about 271, which is around 50% of credit. Can't really speak on losers just yet. Win rate also is wrong. Well, that's because we have some. I need to change this. I'm only going to look at total closed trades versus um, win rate should be total wins divided by total closed trades. Did I get that wrong? Hang on. Wins divided by closed trades. So, and the running P&L, and again, these are one lots. We'll talk about the notional value and profit target and stop. So, running P&L is just over $10,000 in 4 months. These are all one lots. I keep track of notional value for every single one of these positions. And right now, what I have is I have 1, 2, 3, 4, 5, 6 tranches in October 31st expiration and 2 tranches in November 28 expiration. Total notional right now is $486,800. So if I was to, for example, market starts to go down tomorrow and it's going down, down, down every day. At some point, I need to say, all right, how much of these puts I'm going to stop out and what am I going to do as far as assignment? Am I going to take assignment on all of them, on half of them, on just one of them? I need to figure out which one. I need to figure out where my stops are, right? And what strike do I commit, take an assignment, right? You can see my lowest strike right now is in November 28 with it, which is 600. I have 605 also in November. I have 605 in October, right? So you need to decide at what levels am I going to stop, what levels I'm going to get assigned. Maybe you take assignment on all of them. If that's the case, you need to make sure you have the capital to take assignment. If that is the case, and then figure out your strategy around selling covered calls. You need to keep track of your cost basis. And the spreadsheet that Tom King shares around his poor man's covered call, it's a really good template to use to keep track of your long core position, which would be the SPY shares, and then you can keep track of whatever covered calls you're selling against those shares, and keep track. And the most important part is knowing your cost basis so that you're not selling covered calls below your cost basis, because in that case, well, you just end up getting out at a loss in the best case scenario, right? Maybe there's going to be a down market, and again, you need to be okay with the idea, if you are going to commit to take assignment on SPY, right? You can't like SPY at 600, and then when it's at 580, right, you're going to look and say, oh, I never wanted to buy it, I didn't, why did I do it? Like, you need to, at 580, you need to like it even more than you liked it at 605 or 610 or whatever, right? So what I'm doing now, again, Monday, Wednesday, Friday, sell an out of the money put in SPY, right? Somewhere around, right? Some days it's 56 DTE, 58, 67, 77. I went to as high as 88. Sometimes those strikes that I was looking to sell were not available. And what I'm doing most recently, right, when I had strikes that, or I was doing monthly expirations, and you can see that the monthly expirations ended the exclusivity somewhere around early August. This was the last time I entered. Well, not the last time, but on August 6th, right, I needed to enter a trade, and there was just no strikes available that I didn't have a position on. So I went to October 31st, which is this is the end of the month, and I believe this is a weekly expiration cycle. And then I went back, and there was something available in the 17th of October cycle, because it still had 70 days. Right, so I stayed with 17 Oct until it had, let's see, and then on August 20th, I went back to October 31st, and I just stayed there. This is a weekly expiration cycle, and now, right, and you can see that this weekly expiration cycle had the 610, 609, 11, 8. Right, so that's great. And now, as the time is starting to run short, right, the October 31st has 51 days. I have to keep selling closer and closer at the money, because you can see that on 9/3, right, I sold 605. We got a big jump in SPY. And I literally 2 days later, right, from 9/3 to 9/5, I went from 605 strike having to sell 620. Right, that's 15 points. That's equivalent to 150 points in SPX. Right, so instead of as the market continues to grind higher, right, instead of selling closer and closer at the money, I just decided to go for more time. I went, instead of 51 DTE, I went to 79, right? So I went for more time until expiration, but I was able to go back 20 points from 620, from 95 to 99. I went from 620 to 600. And now as the market again is starting to move higher, I had to move up 5 points, but I'm still at about 605, right? At 79 days until expiration. This is the trade from earlier today. I have 79 DTE for $5.15. It has $60,000 notional value. My profit target, I'm going to try to close out this trade for $2.58. And if I'm going to stop out, my debit is $16.20. We could enter this as a GTC stop, or I can say, I can look at this price and say, am I close to 1620? If I'm at 1590, right, with a lot of time until expiration, then again, as mentioned before, if I'm at 1590 and I know that I need to stop out at 1620, that's a 30-cent difference, about $30 difference. Do I want to wait and let, potentially, right? It doesn't happen all the time, but what's going to happen, one of two things. Either SPY is going to bounce and, right, I don't stop out and I never have to stop out, or I don't stop out because, if my stop is at 1620 debit, I'm at 1590, I choose not to stop and wait for 1620, market closes the following day, we get a big gap down, and now this put is not trading anywhere near 1620. Maybe it's at 1950, right? So I'm way past my stop. Why? Because I decided to play a chicken game and, save myself 30 cents. And instead, now I have to eat a $5 loss, addition to what was already planned. All right. So again, a lot of discretion needs to be applied. This is not a, my way is right way and everything else is wrong way. That's not the case here. One thing I want to add is that, guys, this is not some secret Wall Street, hidden in plain sight BS strategy that, I definitely did not invent this, right? I'm just sharing what I'm doing, how I'm doing it. And if something isn't right, something I feel that could be done differently, better, more efficient, whatever the case may be, I'm going to apply these changes. I'm going to share with you guys, and it's not going to be, I reinvented something. I've spent 20 years on Wall Street working on this. I'm finally going to bring this to the retail guys. That's not the case here. It's all a bunch of nonsense. It's very simple. You sell a put, you get to your profit target or your stop. And if you don't want to stop, if you're willing to own shares at a lower price, take the shares. This is not some super sexy strategy that's going to give you, 300% return on capital in a year. It's not, right? If you want to talk about how much can it possibly make you, what kind of return you might see. Again, if you're going to trade with intention of taking the shares, right, which means that if you're holding, what's that, about 8 tranches, you have to have $486,000 sitting there. Maybe it's not sitting in cash. Maybe it's sitting in some high-paying savings, or it's sitting in a T-bills or something like that, right? So you could account for that. On top of that, you will make, if we go and let's just assume, right? This is a very small sample, so we can't really extrapolate, but let's assume that we go at the same pace, right? If in about 3 months you've made $10,000, so, the math is pretty straightforward, right? Take 10,000 divided by 3 times 12, right? That's $40,000. $40,000 plus, let's just assume that you're doing this with a $200,000 account. So you're holding essentially $486,000 worth of risk right now in a $200,000 account, which means, right, 486 over 200, you're taking about 2.4, let's just round this off, about 2.5x notional leverage. It's not crazy, right? 2.5 times notional leverage with SPY is not that crazy. Right, so let's just assume that you're doing this in a $200,000 account. At this pace, you're probably going to make about a $40,000 profit with assuming there are no losses, and we just go for a couple of years with pretty steady gains like we saw from 2022 to 2024. Again, this is like, I don't mean to cherry pick, and I'm just giving you like the best case scenario, and we can try to take um, data that we have from the other campaign and apply it to this campaign. But let's just let's compare apples to apples. So in a $200,000 account, you make $40,000 selling these SPY puts. Just that by itself, right? What's your rate of return? About 20%. Now, if you can do that, right, you're using 2.5 times leverage, right? You're going to make 20%. How much of stock picking, chart reading, news scanning, research doing are you really doing? Nothing. You sell a put 3 times a week. You either hit your profit target, hit your stop loss, or you take assignment. And if everything works out, if the market doesn't puke, if if everything is just the way it has been, and the market is just going to drift higher over long periods of time, if you make 20% really trading just this is the easiest hard job ever, because it's not so easy to hold this through the market debacles. And yes, it's going to happen, and sometimes, right, even if you commit to take an assignment on all of these shares, right, you're saying I have a $200,000 account, but if worse comes to worse and I have to take assignment on a $500,000 worth, I'll transfer some money from my savings, from CD, or whatever the case may be. I'll take the shares temporarily, I'll wheel them out, because I believe that long term SPY is going to have an upwards drift, and or whatever the case may be. And what, those are the times where it's not easy. Most of the time, you put this trade on, you don't have to do anything else for it. It's just there's no adjustments, there's no delta balancing, there's none of that, right? The numbers in the end are going to work themselves out. All right, let me go and look at some questions if there are any. I know we've talked about this before. We don't talk about this strategy enough, maybe. But again, questions came up in the last couple of days. Somebody asked, and that's why we're talking about it. And if you ask about it, then we'll know what we need to talk about. Let me go all the way back, and I apologize. I did not keep track of this chat, so now I am going to go back and read some of the questions. If you make this campaign trade, K Fall says, and the market is at all-time highs, do you wait for pullbacks or enter the trade knowing it's about expectancy and continuing to add more? For example, if it falls today, would you add the next trade in the campaign regardless of SPY? I would just enter regardless of SPY at all-time highs, 5% off the highs. Just put this on. Another way to do this is, for example, you can set a limit, right? This is going back to what I just said. So if you're doing this trade in a $200,000 account, and some people may say, whoa, I don't have a $200,000 account. I only have a $40,000 account. Well, you can still do it. You just have to understand the notional value of these contracts and how many X over your net lick are you trading, right? If you trade this 10X, right? 10x your accounts if you're doing $486,000 worth of SPY shares in a $40,000 account. The higher the leverage, right, the more disastrous things could become if you're forced to take a stop on all 8 tranches, right? Let's just go there for a second. If, let's say, how much of a loss, right? What is my um, P&L loss for the trade? I'll take this. That's my exit minus this is my entry, right? That's a loss of $10 and some 9 cents times 100 shares. That's $1,000 loss, right? If I stop out on this tranche, I will lose $1,009. Right? So if I, for whatever reason, market is going to dip hard in the next couple of days and I'm forced to take a loss because I can't take assignment, maybe not even on one, right? So if I take assignment on one of these tranches in a $40,000 account, this is a $61,000 trade, right? So if you can't, you have to. I mean, unless you're going to hold, SPY shares on margin, and maybe that way you can do it. But in any case, if you cannot take assignment and you did all 8 tranches in a $40,000 account, if you're forced to stop out on all 8 tranches, you will have to take about an $8,700 loss. Okay. $8,700 loss in the $40,000 account is a 20% drawdown. It's a 21.7% drawdown. Right. So you kind of have to think about, right, how much leverage do you really want to take? Right. So maybe if you say, you know what, I'm only going to do, 3x leverage in the $40,000 account, if you just do 2 tranches, that's $122,000 worth of SPY shares. In a $40,000 account, that's 3-to-1 leverage. So maybe you can do 2 tranches, and then when one comes off, next one goes on. One comes off, next one goes on. Right? Is that the only way? No, but can you do more? Sure, but understand that the more tranches you do and the smaller your account, every $1,000 loss in the $40,000 account is a big chunk, right? So understand the leverage you're taking, understand how much losses you can potentially take if everything, doesn't work out. And as we saw before, sometimes when these losses hit, there's a bunch of them and they all come, on the same day or they come within a few days. So, do keep that in mind. So, sorry, I'm kind of went off, but I felt like this was a little too important to not mention. So, leverage is, very interesting thing. You can leverage and win for a long time until that one time when leverage works against you. But if you think about this leverage before you do anything crazy, you could potentially save yourself from putting yourself in a tough spot. K-Fall, back to your question. I don't wait for all-time highs or whatever. Just put it on Monday, Wednesday, Friday. And if I feel like, 8 tranches for me is maybe enough, right? Depending on your account size, maybe say, you know what, I'm going to go up to 10. And then if nothing comes off, and regardless of what the market is doing, if I'm at 10 tranches until some of these tranches come off, I'm not putting anything else on. That's one way to do it, but that's very individual, and you kind of have to, think about that beforehand. Time Merchant says, what was average return on investment for a single lot trade? Again, it depends how you're going to measure return on investment. Every one of these tranches in a portfolio margin account takes up about between $5,000 and $6,000. So if we're going to make an average of $270, or what does the math says? So average winner was about $270. If we just do that, 270 divided by maybe 5,500, right? It's about 5% return on investment. Investment being, how much capital did you put in? If you measure your investment on, notional value, or maybe you multiply your initial margin by 3 just to be on the safe side, it depends what you use for investment. And if you count that $270 average win on an average notional value, which was 57,000, then that number is really ugly. It's about a half of 1%. Return on notional value of the trade. So let's see. Another question. So what are we looking at in summary? Buy and hold versus selling naked SPY overall as return on investment. Again, what I just did, I think that buy and hold works if you want to be completely hands off. You just have to be reinvesting dividends, and you have to continue to contribute to your account. You can't just buy one time and hold forever. And if you just continue to add to the account, continue to either dollar cost averaging, or continue to, put fixed dollar amount every week, every month, every 6, whatever the case may be, and do nothing, never sell, right? Or just reinvest. I think that is going to, win over a lot of crazy strategies that are out there. But it also doesn't require any effort, right? So like, what is your time worth to you? If you want to put the effort in, you will get a better return on effort by being actively involved in the markets. But if you just want to kind of be hands off, buy and hold, a thing wins in the long run with reinvestments of dividends. This is probably like a backdoor buy and hold type of deal, where if you just use a little bit more of a leverage, right? But then again, you're not dealing with some, high flying. Today we have AI. Tomorrow we're going to try to corner Bitcoin market, and next week we're going to try to corner NFT market kind of a company. I'm not saying that strategy, MicroStrategy, whatever they're called now, is a bad company, but we're dealing with SPY, right? So if you believe that SPY is going to drift higher over long periods of time, and you're willing to take shares at some points in time and potentially sell covered calls to get yourself out of these long share positions, because again, our goal is not to own the shares for the long run. We're just using our capital, and we're leveraging that capital a little bit more. And in the worst case, right, as collateral, we're taking on the risk of having to own the shares. And even if we own the shares, we're going to possibly get dividends and sell covered calls, bringing in more income. And I think that in a decent market, we can probably do a little bit better than just buy and hold in the long run. But this is going to be pretty close to it. Hopefully this answers your question. What happened during the big VIX spike in 2025? We talked about it. That spike, the VIX didn't spike from 0 to 60, right? This was already a difficult market. And as I showed before, there were a bunch of trades that were already stopped out in March, before that spike that you might be mentioning, Rick T. At what delta do you use to sell puts earlier? I mean, I just talked about it. So it's not about delta before. This is the previous version. My average credit was about $1.34. So I look at the dollars. How much am I collecting? It kind of worked out to be somewhere between 5 and 7 delta. Right now, average credit is 271. And if you open your brokerage platform right now and say, look, I'm going to go out 70 or 71 or something closer to 70 days until expiration, and I'm looking for about $2.70. Oh, sorry, $5.35, because that's what my average credit is right now. That's probably going to work out to be somewhere between 15 and 20 delta. And the more aggressive, and I think that you will review the recording of this video where I talked about, the reason why I moved. But in a nutshell, I'm moving closer to at the money, collecting a higher credit, getting out of the trade a little bit faster. I feel like I'm not put in a position to build out a huge inventory of short spies. And then when the market rolls over, I have to take a bunch of losses. I think by turning over inventory much faster, I will have less number of tranches. So potentially my losses are going to be cut a little bit shorter. But I think that the big factor of why I moved from selling farther out of the money to closer out of the money is because my average days in the trade is much lower. That means I get to potentially turn over the same, because remember, these trades that are coming on, coming off, we're just recycling the same margin, right? So it's not like we're just adding, and margin requirements just continues to expand. We're turning over that same margin a little bit faster, so we're probably getting a little bit more efficient with return on capital. As far as template, I'm going to look. I've shared the template before. If not, I'll make a copy and I'll share it again for you guys. Again, me giving you access to this spreadsheet, it doesn't do anything for you per se. I encourage everyone to use something like this, or you can go and ask ChatGPT to build you a spreadsheet that's going to help you keep track of your trades. But whatever you do, keep track of your trades. So this way, whether it's last 4 years or last 4 months, you can go back and compile some of this data and get an idea of where you're going. And maybe you need to figure out, what you can do to improve or make things more efficient, or, how to potentially avoid certain things. Or you can maybe, based on the data that you're collecting and you're trading, you can share with everyone in our Discord. And I'm pretty sure that many people may be in similar or same position as you are. If you ask the right questions, we can potentially find the right answers. All right. So I think I answered all questions that we had so far here. If not, if you have more questions, you can always find me and ask questions on Discord. Hopefully, I got you guys to think a little bit about these short SPY put campaigns. However you do them, if you do something different, if you do something that's better, more efficient, whatever the case may be, please feel free to share with others, ask questions. And, remember one thing, guys, you always take care of the risk first. The profits will always take care of themselves. All right. So you take care of yourself, and I'll be back on Friday. Have yourself a good day. I'll talk to you guys next time. Bye, everybody.